naming charities and wills and trusts. That's probably one of the top things we saw last year with all the uncertainty about the Peace Amendment and will there be a charitable cap? Because, by the way, both campaigns talked about that. Governor Romney wanted to maybe to limit it at $25,000 or $50,000 a deduction for charitable giving, and the president was focusing more at capping charitable deductions at 28%, which would significantly reduce, particularly as we're raising income taxes, it would significantly reduce giving, not make it a very fun environment. Good news, cap did not happen, and we'll get into that a little bit in a second. But with all that buzz and all that noise and P's and all these things flowing around, naming a charity in your will, having a percentage go to that charity, at some point, having them as a beneficiary of a trust, a life insurance policy, and we'll get into another way to do that, is, I know this is old school planning, but y'all and the society is actively pursuing it and being part of this. And we don't know what's going to happen in the taxes going forward, but one of the easiest things to do is to make sure that you can continue to have an impact in the charities you support, is to name them in your will. IRAs have beneficiaries. Now, IRAs are great for not paying income taxes, right? Except when you receive the asset, but they are a bear once they go to your beneficiaries. Rules have gotten a little bit easier over the last number of years, but if these assets go to your spouse, your partners, your kids, however you're driving those assets downstream, they have to pay ordinary income tax on those assets. So they're a difficult asset. So the first asset that you should think about, I would encourage you to think about giving away to charities, are high tax assets. And naming a charity as the beneficiary or partial beneficiary of your individual retirement account is an extraordinary way of doing that. And we're seeing a resurgence of charitable remainder trust now, a slow resurgence because of the increase in the capital gains rate. But essentially, this is a giving technique where an individual can give appreciated securities to a trust. That individual gets an immediate income tax deduction. That individual gets an income stream back from that trust, and they don't pay lump sum capital gain on that asset that was transferred in. Going back to that low basis Coca-Cola stock, I move it into a trust, it's sold. Trust doesn't pay immediate capital gains. I pay the capital gains rates on it as I receive those income and some other taxes as well. And then 20 years, the period of time, and then when I pass away, or at the end of the term, whatever's left of that appreciated securities that are invested, old Coca-Cola stock, that goes to the charity that I name on the front end. And so it's a really neat way to play it. So they thought about using charitable lead trusts. Charitable lead trusts, Billy and Hope are really excited about this. It's a really unique way if you're benefiting or want to benefit a charity right now and are already doing that. It's a nice way to still do that, but at the same time create a pool of money, a trust essentially, for your kids or for your grandkids. And if you do the right type of planning, that type of trust could conceivably never pay out or never pay any taxes on those assets. So how does it work? Essentially, assets are gifted to a charitable trust, and depending on the type of trust, it's whether or not you get a charitable deduction, and typically you don't on the front end, but the asset goes into the trust. That trust makes it a gift to the charity for a period of years, say 20 years. And then whatever is left over in that trust after 20 years, the remainder goes to kids and grandkids. This is particularly, and there's a number of reasons why we're seeing some of these again. This is a really old school traditional planning technique, but because ordinary income rates are raised, because the medical surcharge rate applies now, taxes are higher, but there's certain rates that apply to the payouts for these charities that if they're low, and right now we're an incredibly, historically low rate for these types of trusts, that just means a bigger bang for your buck, a bigger deduction or more assets to your kids downstream.